In this video, we are going to analyze a simple costing report or a production order in SAP. And we are going to focus on the material costing for production order. In an earlier video, we have discussed the basic principles of material costing for a production order. So if you have not watched that video, please do that, because this video is a continuation of the previous video. So you have taken a production order. You can use the transaction code CO03 to view the production order. This production order is already executed. In other words, this production order has been was created after converting from planned order. Then actual goods were issued, which means the actual quantities that were required to make this the finished goods were issued to this production order. The operations that are required to complete the production process of the finished goods have been confirmed. And while confirming, the actual time that is required for labor, setup, etc., has also been entered. And finally, once the finished goods have been produced, the goods that have been found okay and should not go into scrap, they have been received in the warehouse. So this entire production process has been completed. So if you see the production order, you can see that initially it was planned that we produce 100 units of DXTR. However, we ended up producing only 89 units of DXTR. Remaining 11 units became scrap. As we discussed in our previous video, that in SAP, this scrap has 0 value. So the yield will be considered as 89, and there'll be no value associated with scrap. This finished goods has various components, which we can see in the component list over here. These are the standard quantities of these components required to make 100 units of DXTR. However, we have issued actual quantities, which is different from the standard quantity, because while consuming the material, some components may get damaged, etc., and hence the actual quantity may vary from the standard quantity as per bill of material. Similarly, there are various operations of making these finished goods, which you can see over here: material staging, attaching seat to frame, attaching handlebar to assembly. Each of these operations have a standard time in which the operation will be completed, and this standard time is against a particular activity type, for example, a machine, labor, etc. That is a standard time that this operation will take, and we recorded the actual time the operation took, and obviously there's a variation between the two, and that will lead to a difference in cost. If you are interested about knowing the details of how exactly this confirmation in the goods issue happened, you can watch an earlier video on plan to produce. The objective of this video is to analyze the cost. So all of these things are already done for the production order. Now we are going to analyze the cost. Now there are various cost reports, and it's a fairly complex process, because while production orders are capturing the cost, finally the cost needs to be settled to cost centers. Centers are departments. So do not confuse between the production order, which is capturing the cost for production purpose, is an intermediate vehicle where we are only capturing the cost of production, but finally these costs need to flow into various departments, which are the cost centers, will accumulate all the costs that have been incurred by that department. That can be for production purpose, that can be for non-production purpose, and then that will give you the total cost of that particular department. That is called cost center accounting. That's again another area of the sub-module of SAP. This one is only considering about the product cost, okay, and we are only talking about the costing for this particular production order, not even for the entire product, okay, because one product can be developed or products can be made from multiple production orders. Product costing again is another separate area. There are again various reports. We will take a very simple report. This is a very, very the simplest possible report, and we will just get a glimpse of how the costing is done. So we went to cost analysis. Just let me go again. So go to more, go to cost and analysis, and you will get one simple cost report. Now you can see there are various columns. Now probably I need a different set of columns. For example, I don't want target cost. Target cost concept is a different thing. Instead I want plan cost, and there may be some other fields that I need. So what you can do? You can customize the field that you need. For example, you can go over here and you can select any column that, so on the left hand side, you have the column that is already there, and the right hand side is the exhaustive list of columns. So any column that you want to be included in the report, you can just select this. For example, if I want material, I can select material and put this arrow, left arrow, and put it over here. And when this comes over here, if I want to change the position, for example, I want material in the beginning, I can just go take this up like this, and I can move this column up to wherever I want. Similarly, if I don't want target cost, I can click on it and put the right arrow so that I push it to the other column list. There. And you see small ticks over there. These ticks are meant for additions. Once you're satisfied with the list of columns that you need to analyze, you can save the layout. You can click on save over here and name the layout and continue, and this layout will be saved. Once the layout is saved, your layout will appear over here, the list of layouts, and you can then subsequently select that layout, and then it will always show the columns that you need. I have already saved a layout, and I'll pick that layout up. So this is where I select the layout, go to accelerate layout. This is the layout I have saved, and my layout has come, which has, as you can see, some other different columns. You can also create a layout which consists of the same columns as I have created over here, because that will help you to analyze yourself. So first, let me just adjust this a little bit so that I can see all the columns. So I have the column of planned quantity, which is as per the bill of material, the actual quantity which I've used, the planned cost, and the actual cost, and the plan versus actual variance. Okay. So there's one plan versus actual variance percentage, which probably is not required at this stage. We're happy with getting plan versus actual. Okay. Now, first, let us analyze the columns. On the first column, you have cost element. Now, as you can see that there are certain numbers which are assigned to raw materials, raw material consumption expense, to be more precise, semi-finished consumption expense, and something called manufacturing output, settlement variance, and labor. Now, cost elements are essentially the heads under which costs are booked. There are two types of cost elements. One is called a primary cost element, the other is called secondary cost. A primary cost element is those cost elements where you can book the actual cost that you are incurring as per the books of account, and which can go to your financial accounting. It's a real cost that can go into financial accounting. For example, when I'm booking the cost of raw materials, we discussed in our previous video, the cost of raw materials issued will be equal to the quantity of raw materials issued multiplied by the moving average price. Moving average price is the real value of the raw material, and hence this is the real cost which can be booked into a financial books of account. Hence, this is the primary cost. Similarly, semi-finished goods consumed, the value of that is equal to the quantity of semi-finished goods consumed multiplied by the standard cost of semi-finished. Semi-finished goods are valued at standard cost, and hence this is the real cost of the goods that you are consuming. And hence, this can also go to the books of account, and hence it is a primary cost element. Same is for the purpose of production of finished goods. The value of goods produced equal to the quantity multiplied by the standard cost of that particular product, and hence it can also go to the books of account. Whereas something like labor that is costed in production order is not the real cost. Now you may say that, how come you are saying that we're comparing the plan versus actual cost, and we're saying labor cost is not, which is a part of processing cost, not a real cost. How is it possible? It's like this. How are you estimating the labor cost? We're estimating the labor cost by the time which the labor is taking, either planned or actual. Planned means the planned time labor should take, let's say 1 hour, versus the actual time which the labor actually has taken. Maybe labor has taken 10 minutes break and actually is 1 hour, 10 minutes. Multiplied by the rate of labor. Rate of labor means what is the cost of labor for 1 hour. Now here is the problem. When you are doing the production, it is impossible to know what is the actual cost of labor for 1 hour. Why? Because of various reasons. It is very difficult to know exactly which labor, what is the salary of that labor who is working on that particular production order. It's possible, but it will take a lot of effort and resources to record that. You do not know exactly what will be the final wages of the labor, because at the end of the month, there may be some calculations of overtime, which is not possible to know when you are running the production order. Production order is running on, let's say, 10th of the month. How do you know what will be the overtime that the labor will get at the end of the month? All those calculations will happen later. There may be some wage revisions in between, some bonuses. There may be so many players. The labor may go on leave. There may be leave without pay. So actually how much you are going to pay to the labor is not possible to be known. For that particular production order, it is possible to be known as a lump sum total. So the best that you can do is you can take an average of what laborers will get and then divide that by number of hours, etc., and then find out what is the average cost of labor who are going to be used in this particular production order for 1 hour, and multiply that with the time. The time can be planned or actual, but the rate is always estimated. That's the best, that's the closest you can go to the actual cost. That is why this amount that you are recording as labor cost in production order, while confirming the production order, cannot go to a books of account, because books of account has to be correct to the T. So books of account can only calculate the labor cost in terms of the wages paid at the end of the month as per the records of the period. There will be a difference between what is being recorded as a labor cost for your production order versus what is the actual labor cost that has been recorded as a whole for the end of. That is the reason these cost elements are called secondary cost elements. Similarly, you will see another secondary cost element, manufacturing output, because we are saying that if finished goods are produced at a standard cost, then corresponding credit entry should be the actual cost, but the actual cost is higher, or maybe in very rare cases lower. But the debit and credit entry has to balance. So what will be that credit entry? Where will that credit entry go, which will exactly balance the standard cost, the value of the inventory at standard cost, which is a debit entry. That's why you have the kind of a intermediate or a dummy account, not intermediate, but a dummy account, which doesn't exactly have any meaning, but is there just to balance the debit and credit. The real expenses is booked in your balance, in your profit and loss. So this is the manufacturing output settlement. Okay. So this is how the accounts are treated. You can see that raw materials are grouped together, whereas semi-finished product is grouped with the finished goods, because this is simply because the way they are valued. Semi-finished and finished are both valued at standard, whether raw material is valued at moving average, and that's how they have been segregated. These are the materials. These are materials that have been consumed, materials have been produced, and origin basically is the plant and material combination, or a cost center and the activity type combination. Now let us come to the most important field, the total planned quantity, total actual. Now here you see there are plus and minus. Plus means consumption, minus means production. So the raw materials that are supposed to be consumed as per plan, 100 is the planned consumption of raw material for producing 100 units of DHDR, not actual. 200 is the planned consumption of semi-finished goods for producing 100 units of DHDR. So the planned consumptions will be plus and the planned production will be minus. Same for labor. Now is the actual. Actual, if you look at, is actually the quantity of raw materials that you have issued to production order. If you go back to your production order record, your material movement record, goods issue, you will see these are the quantities. Similarly, this is the quantity of semi-finished goods that has been issued. And 89 is the finished goods that have been produced in good condition. Right? That's what we saw. Remaining 11 was scrap. So 89 is minus. So this is the plan versus actual. Now the planned cost. How will the planned cost be calculated? Quantity multiplied by rate. So quantity 200 multiplied by the rate of TRW. Now which rate should we take? For semi-finished product, it will be the standard cost. So for TRWA, let's figure out what is the standard cost. We can go to Material Master, MM03, and check what is the standard cost of, what is the standard cost of TRWA? We'll get the values in the accounting view. It is specific to a plant, so to give the plant code. So you see the standard price of, say, finished goods is 113 rupees. So if you go back, 113 rupees multiplied by 200 is 22,600. This is the planned cost of TRWA. Similarly, if you find out the standard price of DXTR, just multiply that by 100, it will be 73,205. You can check that. Just check the standard price of DXTR. It will be production. So that's why it's minus. Go to the accounting view. $732.05 multiplied by 100. It should be equal to your 73,205. 732.05 multiplied by 100 is the planned cost of DXTR, which is produced, and hence it is minus. Now let's look at a raw material. Let's look at our favorite raw material, BRKT, 100. Now let's see the price of BRKT. BRKT, remember, is managed as moving average. Okay, inventory is valued on moving average. However, remember that when the standard cost estimate was done, the costing of finished goods was done assuming the moving average price of BRKT at the time of standard cost estimate, which is different from, which might be different from the moving average price today of BRKT. So when you go to accounting view, you need to understand this carefully. When you go to the moving average accounting view of BRKT, you see that the moving average price is 72 rupees. But if you multiply 72 rupees with 100, that will not be the planned cost. The planned cost is not 7,200, it's 7,000. Why? Because 72 is current moving average price. When the standard cost estimate was done, the moving average price was different, and that is usually recorded here as standard price. Usually, this even though you are not valuing the inventory at this price, but this is the price that is used for standard cost estimate, and that is the reason why it is updated here as a standard price. It's manually updated. You can provision for escalation of price, etc., and you just manually update that, and accordingly, SAP will calculate that to figure out the plan cost for BRK. Similarly, all other law. Now let us, so at every sub headings, you have the summation, and at the end you have the final sum, and the final sum here is 153.45 minus. If I ask you what would be the ideal value of this final row, which sums up the production and the consumption, production is minus, consumption is plus, what your answer would be? If you are answering 0, you are absolutely correct. Because understand that we are talking about producing something by consuming some resources. And in this particular case, the consumption is planned. As per standard conditions, this is the amount of the value of resources I'm going to consume to produce something, which is raw materials and process. So obviously, the value of my produce has to be equal to the value of the resources that I have consumed. That's why the minus and plus should balance, and this should be 0. But here it is not 0. It's little, towards the negative side, small, which means that I have valued my finished goods. The standard cost of the finished good is slightly above what it should be. It is slightly overvalued. Okay. Now, as long as it is small, it's no problem. But if it's a big amount, then you are not getting the actual variance because you have overvalued the standard cost of your products. So ideally, it should be 0. Now let us go to the next, which is the planned versus actual, the actual cost and planned versus actual variance. Actual cost is simple. In the same way we calculate planned cost, which is the planned quantity multiplied by the standard cost, standard price, in case of semi-finished and finished goods. In case of raw material also, it is the moving average price at the time of standard cost estimate, which is entered as standard price in the material cost. Okay. Now, what will be the actual cost here? In case of semi-finished goods, the actual cost will be the actual quantity 201 multiplied by the standard cost. The standard cost was, if you remember, it was 113. So 113 multiplied by 201, it should be equal to 202,703. Similarly, the actual cost of the inventory produced is 89 multiplied by the standard cost of DXTR, which was 732.05, which should be 65,152. But what about the actual cost of BRKT? Now you see actual cost of BRKT is 7560. If you calculate 7560, let's calculate 7560. Remember, standard cost was based on the planned cost of BRKT was based on the planned quantity multiplied by the moving average price at the time of standard cost estimate. or any other price that the costing manager would have decided at that point. So it was taken from the standard price. But now 105 will be multiplied by 72. 72 is the current moving average price of PRK to get the actual cost. So actual cost will be calculated based on current moving average price of PRK, whereas the planned cost will be calculated on the cost that was considered prudent for BRKT at the time of standard cost estimate. That can be the moving average price at the time of standard cost estimate, or can be any other price which the costing manager feels is. Obviously, the difference between this is the planned versus actual, and you can get the percentage from that. Now, interesting thing is that if you look at the sum, 9,692, so this shows plus. That means the actual is more than the plan. So the variance is towards the positive side. However, there is a foul here. What is the foul? Because I already have inflated the standard cost estimate by 153 rupees. So actual variance is not 9,692.35, but 9,692.25 plus 153.4. Because my already the standard cost of my the finished goods is already inflated. So this is how you can analyze the basic material cost for a production order. Remember, these are costs for production order. Many production orders will have products. From there, you get the manufacturing cost for the product. There will be post-manufacturing expenses for the product. Those will add up to figure out what is the cost of a product. This entire area is called product costing. Then all of these costs need to be booked in a cost center. Cost center will have other costs which are not related to production. Those costs together will constitute the cost of a particular cost center. That is another area called cost center accounting. So these are all involved areas of SAP. We just saw a very basic glimpse of how material costs can be done for one single production order. However, hopefully, this gives you some idea about how well SAP handles these complex issues of costing. When we read textbooks, we usually see very simplistic examples, but in reality, in business, costing can be extremely complex.